We are with Paul Harmon once again for part two of our session with Paul, Setting Your Foundation. And in this example, we're going to be doing a screen flow, and we're actually going to get into the numbers and get into specific examples and scenarios of what's possible with the strategies that Paul has been laying out for us. Today's session is going to be unbelievably important and unbelievably valuable to you. It could easily be worth millions upon millions of dollars. I know it will be for me. So pay attention, take some notes, and definitely go through this video 2 or 3 times if needed. But Paul, welcome back.
Hey, thank you.
And let's go ahead and jump right in, man.
Let's do it. One of the biggest questions that I'm always asked, Mike, is how to manage cash and understanding how money flows, velocity of money, etc. And one of the things I try to stress to folks is it does not have to be nearly as complicated as I think people in my industry tend to make it. So what I'm going to share with everyone today, I just want to warn you right now, there is nothing that's really earth-shattering about this, but once you understand the basic simplicity of it all, that's where you'll notice a genius in terms of what takes place. So if you'd allow me, let's just kind of talk about money as far as cash flow, first of all. There's a very simple foundation that all of us understand, and that is, and this is a concept, this is not going to be blowing people out of the water. When money comes in, money goes right back out. I think we can all agree on that.
Sure, yeah.
All right, so knowing that, there's 5 very basic principles that as long as you can wrap your head around these, and again, let's not over-engineer this and make it more difficult than it needs to be, you should be in really good shape. And the last comment I'll make before we get started, I think one of the things that everyone needs to understand that as long as you have good fiscal habits, good financial habits, in the long run, everything's going to work out okay. So for starters, let's start out with concept number 1. The very first thing that we need to understand is that step number 1 is that we need to establish an emergency fund or a cash cushion. Mm-hmm. And this, by the way, this is really important to understand that this can be applied not only to your personal finances but also a business. In the context that I'm putting this in, I'm putting it on a personal level. And here's what I mean by an emergency fund. People, I think, generally will start jumping to conclusions and start thinking of, okay, I need some type of a reserve account. That's not what I'm referring to. I'm talking about to basically safeguard you from Murphy's Law. When old man Murphy sticks his head into your life and starts wreaking havoc, you want to make sure that you're prepared for it. So, and I'm talking about for simple little things like the nuisances, like your brakes, having to replace brakes in your car, hot water heater if you own a home, tires, speeding tickets. You'll notice that I have a lot of these with automobiles. I tend to drive fast automobiles, so I tend to get pinched a lot and caught a lot. So perhaps that's maybe where I'm going there. The example that I use is very, very fundamental. I usually, I'm suggesting $3,000 to $5,000, and let me put that into perspective for you. That is for someone starting out. So if you're talking about someone at only at about $100,000 level, 3 to 5K, anyone who's earning, between 100 and let's say 300, believe it or not, the amount more that you need is not that much more. You're only talking about 5 to 7. And above, beyond that, you don't really need much more than $10,000. And I don't care whether, you're earning $10 million, you're earning $1 million a year. And the reason why is because these, again, are not to carry you through tough times. This is primarily for those little things that you ordinarily would be reaching into your wallet and pulling out the plastic.
Yeah, cash on hand.
Exactly, cash on hand. And it's important to understand that whenever you dip into this, you always put it back. Mm-hmm. So almost think of it like, and I think if I were to draw a visual for people, imagine like if you're pouring liquid cash into a top of a plumbing vehicle, and that's the first bucket is going to be your emergency fund. And in our industry, we tend to use the term buckets a lot, so just kind of keep that in mind because I'm going to use it later. Second step, this is something your mom and dad has been telling you, your grandparents have been teaching you for forever, and that is you want to eliminate debt. Now, specifically, I'm talking about non-preferred debt. Now, what does that mean? I'm talking about things like credit cards. Ideally, you want to treat it like a checking account. You don't want to carry balances on a long-term basis. Installment loans, car loans, basically anything other than a mortgage. Now, why would I say anything other than a mortgage? It's because the mortgage is the only thing you have right now that offers a tax haven. So real simple, cut and dry. Not all debt is created equal. And in fact, for those people who follow the, Robert Kiyosaki, using OPM, and when you can get a tax advantage makes a lot of sense, which we're going to dive into in a little bit. Step number 3. This is where, when I start talking about having funds available, most people immediately assume this is what I was talking about. which is you want to maintain an element of liquidity. And by that I mean you want to have ample enough, and of course I like to think positively, you want it for opportunities. But the reason why is that traditionally speaking, when you have this type of liquidity that I'm talking about, they're usually for bad things. Let's say if you're an entrepreneur and all of a sudden there's an interruption of income because you're in between platforms or businesses or whatever the case might be, you want to make sure that you have enough reserves to carry you through. Again, I'm presenting this primarily on a personal level, but this also applies to a business. Now, what kind of money do we really need to have? To be able to cover both, I'm talking about having 1 year's worth of income or 1 year's worth of expenses. Now, traditionally speaking, and again with Financial Planning 101, they focus on the bad things, which is the interruption of income. There's a big danger if you only plan for that. And that is simply this: an opportunity comes up. Most entrepreneurs happen to be visionaries, so what do? They'll dip into that fund, and they figure, with good intentions, they're going to put it back. The reality is, I've seen this way too many times. Folks don't put it back.
Yeah, I have to say that for me, I like to put that money into very liquid assets, but assets that are out of sight, out of mind.
Absolutely.
Precious metals is one way because it's extremely liquid, but at the same time, it's you have to either mail it somewhere or go to the store to cash it in, and so there's that hassle factor of that.
That's what I refer to as deterrence. You want to set up some firewalls.
Yeah, and
Exactly.
then there's accounts with companies like goldmoney.com, and you can leave money in there just like it's a checking or savings account, or use it to buy precious metals or transfer it into other currencies if you want. But I found if the money's in there, it's not something that I use every day. I don't have a check card for it. I don't have a checking account for it. I have to transfer it back in my primary account, and so that's a deterrence there. Yep. And so that's how I personally handle that. So
and that's a good point. And actually, one of the things that we're going to really dive into deep after we cover all this is where can you put some of that money. And in fact, one of the things I'm a big proponent of, as you know, is that there's other areas where you can make money on your own money, tax-free, which is kind of cool. So, but we'll get into that momentarily. Hold that thought, because as I start going through these, people start wrapping their heads around this. They think, okay, this is really fantastic. But ultimately, the question comes up, and I know this is one of the things you wanted me to cover. Great, where is it that I'm going to put that money? Mm-hmm. And we will address that. All right, but again, the financial model that I'm talking about, with relative to the 5 steps. So step 3 is you want to have enough liquidity regardless of where you put it, so you have access to those funds should you happen to run across tough times or an ideal opportunity come up. All right, next thing. This is something your parents and grandparents have been telling you for years. If you're going to own real estate, particularly your own home, your primary residence, you want to own it. You want to own it free and clear. So that's one of the big American dreams, is to own that house free and clear. Now, I know some of you out there might be thinking, well, I've read one thing that tells me one thing. There's whole different types of trains of thought on it. But hopefully I can shed some light on that in a second here, because I'm going to show you an example that'll blow your mind. What I'm talking about, there's 2 ways of paying this off. You can either pay it off to the bank, or you can pay it off on your actual balance sheet, which means that you have an offset account equal to or greater than whatever the mortgage is. So I'll give you a perfect example. If you owe $400,000 on a mortgage, so you show that on the liability side of your balance sheet, but you also have $400,000 in assets, as far as liquid assets. In effect, they kind of nullify and they cancel each other out. Naturally, if we have a CPA here, he's going to say, yeah, but there's a cost associated with that. Hold that thought, because I'm going to actually show you a real simple example. And just for the sake of simplicity, I'm going to take, again, something very rudimentary because the numbers are lower and they're easier to look at. Naturally, if you want to start doubling, tripling, quadrupling these numbers, it's all relative. So here I show you an example. I call it a tale of 2 neighbors. Now, basically, our story follows 2 neighbors that are each earning your traditional, W-2 wage earners, earning all of $70,000 a year. They've managed to save $40,000 in savings, and they're both buying $200 homes. These days, I won't buy you much. Again, this is just for an example. We have Tom Boren on the left side, who is the traditionalist. This is doing what mom and dad and grandma and grandpa have always told him to do, which is to pay that sucker off to the bank as quick as possible. Then we have the hot girl on the side, Kelly Rich, look at the big smile on her face. Okay, she subscribes to the equity harvesting concepts that I'm a big proponent of carrying a bigger and longer term mortgage. Again, it's the whole principle of OPM. And if you follow people like, the Donald Trumps and the Robert Kiyosaki's, this is the tune that they sing. And there's a reason for it. Now, when I came up with this example, obviously the interest rate environment was a little higher than what it is today. So here's an example that I use. Imagine, now think about this logically, if you're given the opportunity to take either a 15-year note or a 30-year note, and the 15-year note is actually at a lower interest rate, which is about what banks do, by the way, who do you think most people would take? Most people would gravitate automatically to the shorter term note because they want to pay off the debt as soon as possible, and they're thinking in terms of cost, in terms of cost of borrowing, without processing everything, which I'll touch base on in a moment. So let's kind of take this a little step further. This gentleman over here, for anyone that knows anything about mortgages, and if not, we can certainly have a segment, diving into detail about this with a whole nother chapter. But when you put 20% down, you avoid private mortgage insurance, which is an additional payment that does nothing but protect the bank at your expense. So now this individual, Tom, actually has a streamlined mortgage. It's 15 years, 6.38% is his APR, his annual percentage rate. He has zero left over because he's basically taken his entire nest egg. His monthly payment is $1,383. Once he takes his tax deduction, now sometimes people have a difficult time understanding tax deduction. When you deduct something at whatever your marginal tax bracket is, it actually gives you, by way of discount from what you owe the federal government, translates into a savings to him. So his actual net cost of the mortgage is only $1,227. So what he also does is he does what mom and dad have always told him to do, and that's, you'll notice over there on the sheet in front of you, he's throwing an extra $100 with that mortgage payment of that $1,227. So that's a total of $1,327 he's paying. Now, some of you at this point might be a little confused and saying, but wait a minute, if his monthly payment is $1,383, how's it $1,227? Well, because of the discount he's getting on tax deduction, Uncle Sam at the end of the year is going to refund him the difference between the $1,383 and the $1,227. Does that make sense? Okay, hopefully it does. If not, then we can, you can call me and you can pay me to explain it to you. Just kidding. In any event, let's do a side-by-side comparison now. Kelly is actually taking $10,000 and putting as her down payment. She's putting the traditional 5%. Notice her interest rate is higher. Now, there's a reason. What we did is we artificially inflated the interest rate also to factor in the PMI, which is the private mortgage insurance. She has $30,000 left that she now invests into a side fund. What the little asterisk, what that's telling you, by the way, is that she has it into a tax-favored account that's earning 8%. Now, for those of you out there who wonder, is that possible? It most definitely is possible. And that's something we can cover, we'll dive into and start looking at afterwards. Bottom line is her monthly payment, and she's also taking an interest-only loan, by the way, which most people, particularly CPAs, would be hyperventilating. They're saying they'll never pay off that mortgage. Now, for anyone who's technical and understands a lot about mortgages, they must start arguing about, can you really take it out for 30 years? Again, this is for illustration purposes only. It's assuming that her intent is to pay interest only, period. So her monthly payment is lower by the mere fact that it's for 30 years and she's paying interest only. Look at her monthly net after cost. The whole thing is tax deductible, which means that at the end of the year she gets a bigger refund. Now, does that mean that we're going to pay the $1,175 and wait for Uncle Sam to give you a refund? Absolutely not. Because what you're going to do is you're going to adjust your withholdings, and if you're self-employed, which I'm assuming that everyone watching this is, you're an entrepreneur, you're going to be operating on net. So it means the quarterly payments you're going to make can actually be reduced. Why give Uncle Sam an interest-free loan? Because I'll tell you what, if you owe Uncle Sam, you're going to pay out the nose for it. So we want to make sure we're on a level playing field. So here's the interesting thing. Here's the epiphany. And hopefully it's giving you a little bit of an aha moment. You have a higher interest rate on the right side. You have a lower interest rate on the other. Most people immediately assume that the one on the left costs less. It actually doesn't. Just because it's a lower interest rate does not necessarily mean that it's a lower cost loan. Okay, so $7.99 per month is her net after-tax cost. Now, because she wants to be on do exactly what Tom is doing from a cash flow perspective, the difference between Tom's $1,227 payment and her $799 payment is $428. So that means it's costing her less money, as I just pointed out. So what she's going to do is she's going to redirect that $428. She's not going to spend it on something, on lifestyle necessarily, because again, we're assuming she's living the lifestyle that she wants. So she's going to take that $428 and match that $100 that he has and put it towards that investment bucket that we talked about at the 8%. Hopefully this is where the part that's going to catch your attention a little bit. You'll notice the side fund on the very top came up with the asterisk. The side fund is assuming an 8% rate of return in a tax-favored account. And that, by the way, is the fine print that's right underneath the $40,000 in savings at the top of the page. Let's take a look at this. Here's what happens. Let's look at the results after 5 years. Tom has received $14,000 in tax savings because of the tax deductions. He has zero left to invest as far as savings and investments, because again, he's been chopping away at the mortgage. Kelly, on the other hand, has $22,500 in tax savings. She's got $83,000 in savings accumulated in a side fund. Again, we have the CPA here, and I don't mean to be picking on you CPAs out there, but again, their thought process is very short term. They're going to be saying, yeah, but she still owes money on the mortgage. Well, here's the reality. What happens if all of a sudden, again, you folks are self-employed, as an entrepreneur, you're in control of your own destiny. But what happens if you have an interruption of income, not losing a job? What happens if you've run your course with one particular business, or you're in the middle of a startup of another one? If that happened to Tom, he has no savings to get him through the crisis. And let me tell you, in today's lending environment, the whole stated income loans, no verification loans, they don't exist anymore. And the forecast right now is that they're not going to come back anytime soon. So the bottom line is he can't even get a loan, even though he's got about $74,000 in home equity, because he can't prove he has any kind of income coming in. So he might be faced with selling the house or facing a foreclosure because he can't make his payments. And that means his credit will basically go into the toilet. And at this point, he has to sell it quickly and more than likely at a discount. And that's, it's business. That's what happens in the environment. And then he's going to have to pay a high real estate commission of anywhere from 6 to 7%, which are about national averages. Now let's take a look at Kelly. Remember I said she had $83,000 in her account to tide her over. She doesn't need a loan. She can easily make her mortgage payments, even if she has no income coming in for years. And the reason why? Bottom line, gang, is that cash is king. Now this may not seem overly exciting, but I'll tell you what, from a safety standpoint, it's kind of sweet. But I'll tell you what, this is where the numbers really start to take a life of their own. After 15 years, Tom's now received $25,000 in tax savings. He's got about $30,000 in savings and investments. Now you might be wondering why after 15 years, how did he manage, if it's a 15-year note, why he has $30,000 in savings? Well, if you've ever seen a spreadsheet when someone's throwing just a measly extra $100 a month into their into making a loan payment, you can actually reduce it by a couple of years. Hence why he's got $30,000. So, bottom line, he's got $30,000 and he owns his house outright. This is with a CPA. Again, I love to pick on him. He's going to be high-fiving him, saying, "Good job, Tom." Now let's look at Kelly. She's got $67,000 in tax savings versus $25,000, and I haven't even factored that into the numbers that I'm showing you folks. She has $282,000 in savings accumulated in that side fund. Now, bottom line, she's got enough to pay off that mortgage on that balance sheet like I talked to you about. Remember you were worried about cost? She's got $92,000 left over versus his $30,000. May not look overly sexy, but again, we're talking about a $190,000 loan. Take $1 million loan, multiply that times 5. Now look at this. After 30 years, this shows you the velocity of money and the miracle of compounding interest. That works both ways, by the way, folks. It works, number one, as far as cost, but it also works from the accumulation standpoint. Tom has received $25,000 in tax savings. Hasn't changed any because he's not paying any more. He doesn't have any more tax deductions because he's not paying any more interest. He's managed to get his savings and investments up to $613,000, and he owns a house outright. By anybody's standpoint, that looks pretty appealing. That's not bad, and it isn't. But look at what it's compared to. Kelly's received $107,000 in tax savings. Guys, she's got $1.1 million now in savings investments compared to his $613,000. So even if she wanted to pay off that $190,000 note, who's better off? I think the numbers speak for themselves. So bottom line, she never plans to pay off her home. She enjoys the liquidity, the safety, the tax savings, and the investments and returns that she gets too much. Now, I'll tell you what, in an earlier segment, Mike asked me in terms of, how did I build up some of my wealth? Well, I use something that's called an equity harvesting concept, which is very simply put the following. We're taking this house, and I only showed it to you one way, $200,000, and we just let the numbers do what they do. Property values, I know we're going through a tough time with real estate right now, but in the long run, historically, and they will continue, real estate will eventually go up back up in value. As it goes up, rather than letting that equity sitting there doing nothing, because it's earning nothing in the brick and mortar of your house, you can harvest it almost like a crop. And that's what I did with all of my properties, as well as everything from my personal residence to my investment properties. I separated that money. I didn't spend it. What I did is I invested it. And once you start doing that, the returns you start accumulating, and when you start building net worth, again, it's mind-blowing in terms of what you can actually accomplish. That's the true power and beauty of leverage. Now, the only reason I'm showing this slide, this fellow here, and Rick, nothing personal, he's not necessarily one of my favorite people, but he did make one particular statement, and he said that when it comes to the mortgage concept, most people, actually not only with mortgages, but with finances, tend to make decisions in a vacuum without really looking at it, how it impacts everything else. And that's one of the things I like to explain to people is I tell them, bottom line, every decision you make is going to impact everything else. So it's very, very important to take that into account before you make any decision. So in conclusion, here's what you're looking at. Now here I tweak the numbers a little differently. Which is more prudent? To have all your eggs in one basket with little liquidity, which means to own, let's say in this case we took a $250,000 house and own it outright, and maybe having $20,000 put aside, $10,000 in cash and let's say $10,000 in mutual funds, which is not my favorite, by the way, or having a diversified asset portfolio, and diversified by my definition, which is to have significant liquidity, which means take out the mortgage, again, OPM, and have it separated. So now you have $220,000 working for you versus having only $20,000. Now here's the important thing that you have to understand. A property is going to go up or down in value regardless of what you owe on it. So quite often what I love to do, and just to mess with people, if I'm ever speaking in front of a group, I'll tell people, say, imagine you have a house that you bought for $500,000. It's now worth $1 million. What's the rate of return you got on your equity? Most people come out and say, I got 100%. Actually, no. That's what you got, the rate of return you got on your property, not the equity. The equity you got 0 because it's tied up in the brick and mortar. The equity does nothing unless you separate it from the brick and mortar. So if there's any point to be made, it's that one right there. And that's when you can start enjoying the true power of leverage. So bottom line, houses are designed to house family, not to store cash. Your investments, which is what we're about to talk about, are designed to store your cash and also to build cash. And the reason why, because ultimately, and this is what Mike and I refer to as having the basis covered, or the basics covered, however you want to refer to it as. You want to make sure that you have in a safe place enough money that you're no longer trading hours for dollars. I understand cash flow, particularly for you internet marketers out there who build these platforms and you develop what I enviously call mailbox money. But nonetheless, to have a base of assets that's generating enough income to cover your basics. In other words, your current existing lifestyle, but not the meager lifestyle. I'm talking about the lifestyle that you want. That's when you have the basis covered, and then at that point you can, as we like to talk about, you can swing for the fences, so to speak. But it needs to be put in a place, and this is what we're going to talk about now, in a place that's going to be safe. So commit to conserve and not consume equity. And again, I'm putting this in the context of mortgages because this is just one concept before we go dive into others. So commit to conserve and not consume your equity from this point forward. And bottom line, you work on a cash budget, not literally, which means that you don't spend more than you have. And ultimately, this is a wrap up in terms of the five pieces that I just pointed out to everybody, which is you having your emergency funds. Depending at your income level, you're going to want anywhere from $3,000 to $5,000 to maybe perhaps as high as at tots $10,000 to $12,000. You won't need it any more than that because those are for those nuisance repairs that I was talking about. become debt-free other than a mortgage. Remember, not all debt is created equal. You want to have enough liquidity to be able to cover your bases, but not only for the negative things, but the opportunities. So you want to have a good year's worth of funds available, whether you have it in gold, whether you have it in cash. Again, we're going to talk about that in a little bit more detail. Pay off the home. And you want to pay it off free and clear, but on a balance sheet. Start thinking in terms of balance sheet concept from this point forward. That will make you millions. And when I tell you millions, I'm not exaggerating. That's not hype. That's real. And then ultimately, you'll have enough where you're not going to have to trade hours for dollars, and you'll be able to maintain that ideal lifestyle. Your definition of a sensational life from the income that just your assets alone generate. And any other cash flow model as far as businesses that you create, that'll be icing on the cake. Now, wouldn't that be great? Here's the funny thing. By introducing a little clarity and direction into your future picture, it's amazing what you can generate. You can develop the confidence to realize that anything is possible.